All right, guys, one thing I want to talk about. I've received a few comments on the gram from people. They literally will say to me, well, how can you be a value investor and your stocks are down? So I want to clarify something very quickly. I've said this since day one. The goal of value investing isn't that that your stocks go up when the market's down. That's extremely difficult. The goal is when markets have massive upsides, you're not following into the stocks that fall 90 or 100%. The goal is to buy good companies at great prices. Okay? Now, unilaterally, but 98 of 100 investors would probably say Warren Buffett's the best investor of all time. So what I decided to do was show you guys that stocks that he owns still go down. Because remember, our goal is to, over long periods of time, beat the market. And beating by 2 or 3% a year is a huge achievement. But if I told you this year the market was up 10% and I was up 12, you wouldn't be like, that's incredible. You'd be like, okay, that's pretty good, right? But remember, in mutual funds that beat the markets over long periods of time, in any given time, in a 10-year period, that they beat the market in long periods of time, they were in the bottom 10% performance of all mutual funds in their categories. That's a huge discrepancy. If you go look at Warren Buffett and his performance over his decades, he didn't beat the market every year, and he won't. So here's what I did. I went to his 2021 annual report, and I pulled up his top stocks holdings. And this is how they've done this year. American Express, January 1st price, 168, currently 146. Apple, 182, 151. Bank of America, 48.35. All these things, and the average he's down is 19.1% in his portfolio. Now, he's in the profit on pretty much all of these stocks right now, overall. And that's the point. The point is he bought at lower prices over time when people were mispricing them. American Express is one of his biggest holdings. Actually, it's his biggest holdings. Nope, maybe it's not his biggest holding.
Apple's his biggest holding.
Apple's his biggest holding? Okay. So the whole thing here is he still bought this at dirt cheap prices, and over long periods of time, he's seen appreciation. That is our goal as investors here. My goal isn't to be like my friend Gary, who's willing to look at micro cap companies. My goal is to sit there and find big companies at mispricings. How do I get that? From mispricings in the overall market, okay? Warren Buffett's doing the exact same thing. He does it very well, but look at this. 47% down, 29% down, 26% down, 34% down, 27, 31. His savior is Chevron and now Occidental. But Occidental, I don't think he had last year. It was a very small position last year. This is his big savior right here. His big savior is one stock. He has one stock that's in the positive this year. I have more than one stock in the positive this year.
Yeah, if you look at his overall holdings, Kraft Heinz down over 50%, HPQ down 25%. A lot of smaller companies, smaller holdings that he has down 75+%. So
it happens. The whole point isn't to sit there and say,
This is something that everybody talks about. Para, Viacom down 41%.
Oh,
Snowflake down 27.6%.
But again, he doesn't look at it from a short-term perspective. So I want everybody to stop thinking that value investing is some magic formula that just beats the world every single year. No, even in Joel Greenblatt's book, the little book that beats the market, talks about high-quality businesses at good prices. He says, if you're not willing to trail the market for 3 to 5 years, it's going to be very difficult to beat the market. And in our software, and this is my testament, in our software, I'll have people reach out to me and say, Paul, you saved me. I started listening to you, and in the last 6 months, I avoided this, this, and this. And what do I always say? Don't thank me. Don't thank me right now. Thank me in 5 or 10 years when your process is done well for you. Yes, in the short run, it could very well work. So I'm being consistent in the fact that I don't even look at the short run for anything. I look at the long run for everything. When somebody says, Paul, the stock is down, I sit there and say, well, so you're the person that would have thought that Amazon at $6 when it was $113 was a bad purchase. Let's think about that for a second. You think it's better to buy a company at Amazon at $113 than $6? That's what you're saying. Yep. If you love it at $113, if you liked it at $113, what do you feel at $6? I have 100 stocks on my watch list, and I hope all of them fall tremendously. And when Mo and I were talking about PayPal today over text with a friend of ours. Yep. And Mo was like, well, I'm going to wait for this price to hit. I'm like, I'm not. I'm going to buy it way sooner than that. So if Mo is right and he's able to buy it lower than me, great, good for Mo. I'm willing to buy it at a much higher price, and as it goes down, I will buy more of it. Mo will wait. Good for him. More power to him. There's also the chance that the price I'm going to buy it at, it never goes to his price.
That's exactly right. And that was something that I said. I was like, maybe it never hits here. And there you go.
And there you go. And that's it. So value investing isn't about beating the market every week, every day, every month, every year. It's about beating the market over full bull and bear cycles, or not beating the market, but having a lot less risk in your portfolio. As I ask you this question, let's bring this question up. It's a question I always ask people. What's better, 10% return or 7% return? And 99.9% of people will say 10% return, of course. All right, fine. What if this one is levered 30-1 and this one's 1-1? Which one's a better return?
7%.
7%. The dumbest person I know in media, one of the dumbest, Grant Cardone, says 6% is better than 0%. He's absolutely 100% incorrect. You have to also account for other factors. What companies are in this portfolio? What companies in this portfolio? How long a period of time is this? There are so many factors. Don't be the lemming who just looks at this number. This is not the right way to look at it. You want a proper return for the risk you are taking.
Yep.
That's it. So if you sit there and you think that 10% is always better than 7%, I need you to turn the video off and go somewhere else and probably flush your mind out of the toilet. You got a lot to learn. And Tim's not going to like that I said that, but I absolutely will say that. It's absolutely asinine to think that way. But I'm here to teach because these are the lessons I learned. Because 15, 20 years ago, I would have said this is better. I'd have been like, what are you, stupid? 10% is better than 7%. Every single day I would have said that. Now I look at it going, man, after being involved in so many businesses and so much real estate and realizing what it takes to make money, I go, okay, I was just meeting with my friend the other day saying, I'm okay not maximizing my returns. I'm going to hold 20 or 25% cash in my portfolio at all times. Why? Because I'm going to use it to sell cash secured puts at a lower rate of return. I'm fine with that. I'm perfectly fine with that. Why? Because it helps me go like this at night. And I'm perfectly fine if that takes me from beating the market by 2 or 3% to equating the market. I'm cool with that. That's what matters to me, is being able to sleep and have a good risk return parameter. I haven't invested in the market in the last 5 years because to me, the risk versus return was not good. There was way too much risk and people thought I was crazy. And guess what? That's what being a value investor is. Everyone thinks you're wrong at all times. People thought I was wrong a year and a half ago. Oops. Now they think I'm wrong now. Okay. So when Alibaba was at $310 a share and I was apprehensive, people are like, you're wrong, you're an idiot. Now it's at $67 a share and I just did a tax loss harvest on it, so I'm going to buy it back here soon. And people think, I'm okay, then I'm wrong here. I wasn't buying it at $310 a share. That's the amazing part. That's what I want everybody to remember. This is about a process. Successful investing is about the right mentality, the right emotion, and the right process. And guess what? Process is a big factor of it, but in investing, emotion and psychology and mentality is a huge chunk of it. Mo and I talk about this stuff all the time.
Mm-hmm. We talk about that more than our numbers.
Yeah, the numbers, we sit there and say, oh, these numbers work great. Now.
Yeah, exactly.
Do we want to own this thing right now?
Right.
By the way, differences. My friend Gary manages a fund. You know what his comment is? I'm a bottom-up investor. I don't care where the market cycle is. I'm buying a good company at a good price. Me, I don't agree with that. To me, what works for me is, no, I'm going to wait for the market to be down a lot before I start buying. Only 7% of my money is invested in stocks right now. Why? Because I think there'll be much lower times in stocks. I'd rather go wait for that. And I wish I'd go back in time and say, hey, wait a little bit longer. So if this makes sense to you, I need you to do one thing for me. You need to subscribe to the channel. We do 2 or 3 videos a day. During earnings times, we do almost live. I mean, 15 minutes after earnings are announced, we're putting our video out, responding to the earnings. You need to subscribe to this channel, especially if this makes sense to you. If it doesn't, I'm sorry, but that's just the way it's going to be. And I'm sorry to tell you this, you're probably not going to do very well in investing. But if this makes sense to you, you have a bright future ahead of you. Subscribe to the channel, you'll learn in time. As the market falls, one of the most common questions I get is, what stocks should I be buying as the market falls? Great question. We're going to get into it right now by looking at our process for how we buy stocks.